So the S&P 500 is down 5.8% from its highs, and the Nasdaq is down about 8.6% from its highs. So could we have made a bottom in this current pullback in the stock market? Let's find out. So the question I keep getting right now is, are we at the bottom of this pullback? Is it safe to start buying, or could we go even lower? So as I keep reminding everyone that there's no way to predict the exact bottom of a pullback or correction or bear market. There's an old saying by Confucius that says, man who tries to pick bottom will only end up with smelly finger. All right. So the first thing to understand is we can never know the absolute bottom. Why? Because there are too many variables, there are too many moving parts in the market, in the economy. Okay. The only thing that we can do is to ask ourselves, is this a potential bottom? Is it a potential bottom? And if it is, then as an investor, what we can do is we can start to dollar cost average into our positions. In other words, we start to add some shares, knowing that, hey, it could still go lower, right? And then we add more. So as investors, we intelligently add at potential bottoms and we average in our position. Remember that in investing, you don't have to buy right at the bottom to make money. You don't, right? As long as you buy when it's undervalued and it is near a support level, you've done your job, because eventually you invest in great companies, they would eventually rebound to new highs and you make huge returns. When it comes to swing trading, again, we can never ever know the absolute bottom, but once we get a potential high probability bottom, then we could enter a swing trade with a predefined stop loss where we risk a small percentage of our capital and a profit target. So if it is indeed the bottom and it bounces off, then we hit our profit target. But if it hits a stop loss, we get stopped out, no worries, then we wait for the next potential bottom to re-enter the position. So it's all about, is this a potential bottom? Okay. So the answer to that question is, it is a potential bottom, but is it the bottom? No one knows that. Okay. So why do I say that it is a potential bottom? Because if you watch my previous videos and my posts on social media, you know that I have identified certain support levels. And the S&P has hit my first level of support, or the first potential bottom. Okay, so let's take a look right now. So about 3 days ago, the market hit this level, as you can see, which is 4331 on the S&P 500. And so far, we have kind of like bounced off that level, right? We've got 1, 2, 3 days of higher highs. So this is a significant level and could be a potential bottom. Why? Well, because of a few reasons. Now, if you look at the weekly candles, now these levels were actually determined by the weekly candles. If you look at the weekly candles, you can see that this was a previous swing high. So remember that swing highs and swing lows are significant, because swing highs and swing lows make potential support and resistance levels. So this was a potential, or rather this was a swing high, which coincides with, you can see this red dotted line over here. Okay, this is the 20 exponential moving average, a 20 EMA on weekly candles that acts as a support level. So you can see that, yeah, it's a bit faint over here, but that swing high coincides with the 20 EMA, and that's a potential level of support. Okay. Now, of course, there could be more levels of support. If this support breaks down, it could go to the next level, which my guess, looking at the charts, would be at 4196. At 4196, you can see again, this is a previous swing high over here. And this coincides with the 100 moving average on the weekly candles. So again, from the top of the S&P to where we are now, we're down about 5.8%. All right. And if we do break down to the next level, that would be about 8% or so, which is to be expected, which is not unusual, because remember that the average market pullback, which happens about 3 times a year, would be roughly about 5 to 10% drop from the high. So that is within the expected range. Now, if you take a look at the daily candles, you can also see why this could be a potential, at least short-term bottom, because indicators indicated that the market was short-term oversold. Oversold is when the price goes down to a level where it tends to bounce back up. It's like a rubber band, it's oversold. You can see the lower Bollinger Bands were pierced by this candle low, and at the same time, if you look at the full stochastics, it was also oversold at that level. So Bollinger Bands, stochastics, and Williams percentage R, these are known as oscillators. They tell you oversold and overbought conditions. So when it's oversold, it's like the rubber band is too tight, tends to snap back up. And this also coincided, notice, with a previous swing low over there. And that's why, again, this could be a potential bottom. So the question is, would we from here rally back to the highs, or could this just be a bit of a bounce before coming lower? Again, that's something that no one can predict because there are too many moving parts. So a lot depends on, number one, today, Nvidia will be announcing earnings after the market. So it all depends whether they announce good earnings and their forward guidance. If Nvidia beats on the results with great forward guidance, yeah, that could lend fuel for the market to really break through this 50 moving average. If it can break back past that 50 moving average, we've got very strong bullish momentum to take us to new highs. But of course, if Nvidia screws up, then yeah, we could go back down again, right? So you can't predict 100%. It also depends a lot on this Friday at 10 a.m. Eastern Time. The Fed Chair Powell will be giving his speech from Jackson Hole, the famous Jackson Hole speech that happens every year where all the central bankers gather. So a lot depends on his speech. Is he going to be more hawkish, more dovish, right? All that will drive the markets in the short term. Okay. So on one hand, the market is really down like 5.8% and the Nasdaq's down over 8%, which could be enough pullback for this bull market to continue. But on the other hand, if you take a look at seasonality, and you guys know, I've told you before, August tends to be a seasonally weak month. Remember that September seasonally is the weakest month of the year. So if you take a look at the history of the markets, you can see September, tends to be a bearish month. And that's why I can't say with 100% certainty that this is the bottom, we're going to go higher, because September may be bearish, right? Now, again, this doesn't mean that September will go down. This is again an average of all the Septembers since 1950. So it doesn't mean that every year September went down. No, there were Septembers that went up. It's just that most of them went down, all right? So will this September go down? Again, we don't know, right? And the danger is that some people say, well, it looks like it's going to go down. I'm going to short the market right now, or I'm not going to buy yet. Let's wait for September. And you could do that. But the danger with doing that is that you're making a prediction. And what if September doesn't go down? What if this time September goes up? Then if you short, you're screwed, right? Now, of course, if you've got a stop loss, that's fine, right? Or if you want to add shares to your investments of great companies that you may have missed out, but you say, let's wait for September. Wake me up when September ends, and then I'll get in only when it looks bullish in October and November. And again, the danger with doing that is that what if this was the bottom and the market takes off and then you don't get the chance to add shares and you miss out on that ride? So over the years, I found that it's not very useful to make predictions because you never know. So what's important, again, like I said, is for investing, you do dollar cost averaging at intelligent levels. Don't blindly dollar cost average like every month or every 3 months. But dollar cost average when the price is at an attractive level, when it's undervalued and it has retraced to potential support levels or potential bottom. So if this is the bottom, great, you get into a position. But if it goes lower, you could still add more to that position. You average in your position. Same thing with trading, with swing trading. Yeah. So at this level, you could enter trades, but have your stop loss there. So if it stops out, then you re-enter when the next long trade presents itself, because we can never predict 100%. So what are some high quality stocks that investors could look to add to? Well, here are a few examples. Now, again, this is not financial advice for you to buy these stocks, but these are stocks that I own myself. They're in my portfolio. I think they're great companies. And over time, I do add on to my positions when they get undervalued again or when they retrace to support levels. So the first one would be ASML, which is one of the top semiconductor suppliers. It's a monopoly in the semiconductor space when it comes to photolithography machines. And you can see, for example, my intrinsic value is $776. Once again, if you wonder how I calculate the intrinsic value, it's based on using a discounted free cash flow valuation model, which you can learn in the value momentum investment course, where you get all the intrinsic value calculators to help you to value shares. In fact, one of the most important ingredients in my investing recipe is to know how to calculate intrinsic value. So you know whether a stock is expensive or cheap. And to, again, buy only when it retraces to certain support levels, right? So for ASML, you can see that it is currently undervalued. My intrinsic value, again, is 776, and it has recently retraced to these levels of support, right? So right now it's at, in fact, it bounced off this 200-day moving average over here, right? Which coincides with this support level 637. So it could be a potential level to add shares as well, ASML, right? So again, it could bounce back from here, but you never know. It could again, break down, of which the next level of support would be 604. So that's what I mean by knowing support levels and then adding in your positions. So again, when I tell my students that if you want to buy, for example, 100 shares, don't go in all at one time right here, because it's a potential bottom, but it could break to a lower bottom. So you could buy maybe 30 shares first or 33 shares first, and then add another 33 if it breaks to the next level. So this is one example. Another example would be Salesforce, which is software as a service. And again, this is undervalued. My intrinsic value is between 231 to 245. Currently, it's selling at 206. It's undervalued as well. And it also, as you can see, this is a level of support here, right? So it recently retraced to this level of support at 204. So this was again a level to add shares to Salesforce, because it's undervalued. Support levels you add, but you add everything? No, because again, there's another two support levels where I would average in a bigger position if it gets to those levels, which we can't predict whether it will get there, but if it gets there, that will be a great deal to add, Another example would be AutoZone, another great business. And AutoZone, you can see intrinsic value is 2577, and it just retraced to the first support level at 2422, right? So you can see this is a level of support. Again, it could bounce off, or it could break to the next level of support over here at 2294. But again, given it's at the first level, it's undervalued, that would be a place to add shares. So again, in the value momentum investing course, you learn how to calculate intrinsic values. You learn how to determine these support levels to average in your positions. And for those people who are too lazy, you subscribe to my Ultimate Investors Playbook, or UIP. That's what I do for you. I calculate the intrinsic value, updated every month. I show you all my support levels. You see my portfolio, my performance, and you can see exactly how I add into my positions. Now, one sector in particular which is catching my attention, which I'm looking to add my position in right now, is actually the consumer staples sector. Now, what are consumer staples? Consumer staples are stocks of companies that sell low price essential goods, things that we use all the time. So examples of consumer staple stocks would be Coca-Cola, Pepsi, Procter & Gamble, Nestle, Hershey's. These are consumer staple stocks. So these stocks are not high growth stocks. They are low growth stocks, but they are very defensive. And in any portfolio, it's always good to have some of these defensive stocks. Why? Because they are recession proof. When you get a recession, when the market collapses in a bear market, most stocks will drop like flies, but defensive stocks may even go up in a recession because they are very, very defensive. Now, usually when there's a bear market or when people fear a recession, defensive stocks are very expensive. They are flying high, right? So for example, if you take a look like last year or beginning of the year, Hershey's was going up like crazy. Pepsi, Procter and Gamble, because people, when they fear recessions, when they fear crisis, they buy all these safe companies. And that's when you don't want to buy, because you don't want to buy when it's overvalued. But now the opposite is happening. Right now, because GDP is growing so strongly, and now everyone is saying there's no more recession has been cancelled, what happened? Now the opposite happens when these consumer staple stocks are now selling off. They are now being dumped by the market. They are out of rotation. And this is precisely the time when I love to buy them. Remember, I'm the kind of person, I'm a contrarian. I like to buy things which are unloved. I like to buy stocks where they're out of rotation, because then I get them really cheap. All right? And then later when I get back into rotation, I make huge profits. So right now, where I'm looking at opportunities is in the consumer staples sector. So let me give you a few examples. Number one, consumer staple stock, Hershey's. Hershey's, as you know, they make chocolates, right? It's recession proof. It's a very defensive company. And again, if you take a look at historically, Hershey's does really well when there is a bear market and there's a fear of a recession. Like last year, fear of recession, bear market, look at Hershey's, whoa, baby, okay? But this year, that the economy is now very strong, no recession, right? What happened? Hershey's, bleh, it goes down. And that's when I'm looking to add more Hershey's, okay? So Hershey's is interesting. You can see that it's now reaching a level of support at 213. So again, could this be the bottom? Maybe. It could be a potential bottom because there's a pretty strong support. So it could bounce off from here. But of course, there's no guarantees, right? It could, of course, break below and go to the next level of support. But given it's a level of support, that's when investors will look to, average in their position into Hershey's. Another example would be Procter & Gamble, P&G. Again, a very boring company, low growth, but very defensive and great to have in your portfolio in times of volatility. So again, usually P&G does really well during the fears of recession, but recently you can see it's coming back down again. But P&G is not yet undervalued. You can see my intrinsic value is 146, so not there yet. I'm waiting to add at this support level at 143, and if it goes to the second support, add more at 138. So I've got all my support levels lined up. Now, next one, Pepsi. If you look at PepsiCo, now Pepsi just got undervalued. My intrinsic value is 179. So you can see Pepsi selling off, and now right at my first level of support, 175. So that could be a level to add shares if you want to build a position in Pepsi, all right? Next level of support over here, 167. Next level of support over here, 159. So these are levels of support to average in your position. That's if you are investing, But if you don't just want to do a swing trade, just want to get in, get out, one night stand, sure, you could wait for a bullish reversal pattern, like a bullish candlestick pattern, and wait for that signal to enter here, but placing a stop loss and a profit target. So you want to risk, for example, 1 hour of risk to make, let's say, 2 hour of potential profit, so that if it goes up, you make your 2 hour, you take a profit and you go for the next trade. Hits your stop loss, get out at 1 hour. So that's more of a trading concept, trading mentality, all right? Two more examples of consumer staple stocks that are very defensive would be McDonald's. So again, McDonald's selling off, all right? Now, those of you who are my subscribers, you know that I sold off my McDonald's position at 291. I marked it over there, and I'm going to look to buy it back when it gets undervalued again, because McDonald's, I sold it because it was way overvalued. I got out, and my average price is very low, so I make very nice profits. McDonald's, the intrinsic value is about 269. So I'm waiting, I'm hoping it'll get back below 269, where I'll start to add in my positions at the first support level over there at 262. Okay, and unlikely it's going to break lower than that, but I will save some cash to add at the next level, but I doubt you'll get there because McDonald's is doing really well. Our last one would be Yum Brands that owns KFC. I sold it at 144, took profit. You can see why. Once it gets parabolic, once it's overvalued, I would tend to sell out my positions, especially for the more consumer staple stocks. And again, if you're subscribing to UIP, you got my sell alerts at 141. I got out over there, right? So I'm looking to buy back Yum Brands, and could I buy back right now? I could. You can see that the intrinsic value is 137 on Yum Brands. Right now it is undervalued, right? And it actually hit the first support level, 132. I didn't add it back because to me it was not undervalued enough. I wanted a bigger margin of safety, right? So I'm actually waiting to see if it can hit this 125 support level. If it does, I'll be a big buyer at 125 for Yum Brands. Now, the great thing about these companies I just showed you, P&G, Yum Brands, Hershey's, McDonald's, although they are not high-tech, high-growth companies, they are low growth, but they are very defensive. They are very predictable. They're very boring companies. But you know what? Even though they are boring and low growth, but over time, if you hold on to them, you outperform the S&P 500. Take a look at this comparison chart on TradingView. And you can see I've plotted the S&P 500 ETF, SPY over here, with those companies which I mentioned. So check it out. The best performing will be Hershey's and McDonald's and Pepsi and Yum Brands. And you can see that they all outperform the S&P 500 index. And again, they are not high-tech companies. They are low growth, but they are very predictable, they are recession-proof, and they are defensive. So it's always great to have some of these very boring companies within your portfolio. Hope you've enjoyed this video, and I'll see you guys on the next one. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.